Hi, my name is Anu Buzruk. I work as a senior academic assistant in the Learning Commons department of College of DuPage, mainly helping with accounting courses. In my earlier video, we looked into the inventory accounting concepts. Now in this video, we will be looking into the inventory costing concepts. Now as far as inventory costing is concerned, first we need to briefly review as to what all can be included in a business inventory. So apart from whatever inventory is being purchased by the businessman or businesswoman, three major points to be remembered here are goods in transit. So whatever goods are in transit, out of them, only those for which the buyer has made a contract of FOB shipping point, means freight on board shipping point contract, those goods will be included in the buyer's inventory, because the buyer becomes the owner of the inventory at the very point of time when the goods are shipped out of the seller's warehouse. Whereas if the contract is FOB destination, then they will not be included in buyer's inventory. The logic is very simple. It is FOB destination, means the goods will become the owner or the buyer will become the owner of the goods only at the point when the goods reach the warehouse of the buyer. So those goods in transit will not be included in the inventory items of the buyer. Then second point is goods on consignment. So whichever goods are on consignment and given to the consignee for sale, those are owned by the consignor, and hence that inventory will be included in the consignor's inventory and not the consignee, because the consignee is just holding those goods in his or her warehouse. And then the third one is goods which are damaged. So these damaged goods will be included in the owner's inventory items, provided they are in the sellable condition. If they cannot be sold, they will not be included in the inventory. And if they can be sold, then the net realizable value will be considered, means at whatever price you can sell those damaged goods minus whatever is the additional cost incurred on those damaged goods. That is net realizable value. Now, let's talk about inventory costing. Why is it that inventory costing is so important? Is because in the balance sheet, we show the ending inventory of all our material as our asset. So the value of the inventory depends on the total value of your assets that you are showing in the balance sheet. Secondly, in the income statement, we show what is the cost of our goods sold. I am writing it in brief. COGS is cost of goods sold. So this cost is reflected in the income statement, and that's why it is very important to value this inventory or to cost this inventory in a right manner. Now, what all is included in the inventory cost initially is, of course, the purchase price at which you are purchasing the inventory, plus whatever are additional expenses on purchase like shipping cost or the insurance that you have to pay, minus any discount that you have availed from the supplier. So that is your inventory cost. Now, at the end of the accounting period, you have to remember to write an adjusting journal entry. Why is it that this adjustment is needed? So any businessman or businesswoman will generally take the physical count of the inventory at the end of accounting period. It can be monthly, it can be 6 monthly, it can be yearly, depending on the valuation of that item. So when the physical count is taken at the end of the accounting period, if that physical count is not matching with the inventory accounting, then you have to adjust your books. So accordingly, you will adjust the books by writing a journal entry. So what is this adjustment or adjusting journal entry? Is you will reduce the inventory value and increase the cost of goods sold. So you will debit the cost of goods sold and you will credit the inventory if your physical count happens to be lesser than the accounting inventory, because that shows that whatever you have accounted for is more. So you will have to reduce the inventory value in your books of accounts. So you will credit the inventory, and of course vice versa. Now let's look at the methods of inventory costing. When we talk about inventory costing, we have to remember about one equation or formula as to how to come up with the inventory cost. It is a very simple physical flow of inventory. So we started our year with certain number of items in our warehouse. So that is our beginning inventory. Then during the year, we purchased another few batches of that inventory or few lots of that particular inventory item. So net purchases are to be added. Net means whatever price you purchased at minus whatever discount you received from the seller, etc., etc. So that becomes your cost of goods available for sale. And then from this item, you will be subtracting whatever is your ending inventory in your warehouse. So whatever is still remaining in your warehouse, when you subtract that quantity, what you get is cost of goods sold. So this is our basic formula or equation which is to be remembered when we talk about inventory costing. Now from here we are going to move on to the costing methods. So you can look into my next video to understand what all inventory costing methods are concerned, are there, and how do we follow them in our inventory costing.